Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. In this latest edition of the Moneymakers podcast, I'm delighted to have a chance to catch up with Craig Baker, who is the lead portfolio manager of Alliance Witan, which you'll recall is the result of a merger that completed in October last year, which brought together two global investment trusts, and which now have a market cap of somewhere, I think, approaching between 4.5 and 5 billion, so becoming an even more significant player in the sector. Since we last spoke, Craig, I think it's fair to say this has been a fairly eventful period. Obviously, Donald Trump has become president, and the Trump administration has embarked on its erratic journey, making a lot of announcements, causing a lot of market volatility, and presumably presenting quite a challenge to managers such as yourself who've got to navigate through these tricky waters. Would that be a fair way to introduce this?
Well, I think it would certainly be a fair summary that it's been interesting times, and we've seen some quite extreme moves in markets on the back of some announcements that have been made and then reversed and then put in again. And so it's definitely been interesting times. I mean, we can come on to this, Jonathan, but I mean, I think this is one of the reasons that we've constructed the trust as it is, which is a bottom-up stock-picking trust and doesn't try to take big asset allocation top-down macro decisions because they're so difficult to make. And this has proved a period where that really highlights those issues for anyone that's trying to run money that way.
Absolutely. I mean, you have to be able to turn on a dime to try and catch these movements that we've seen in the market. I mean, down very sharply in the first quarter and then bouncing back very strongly, particularly the US market has bounced back a long way. So how do you actually approach this? What do you say to your stock pickers in periods like this? I mean, obviously some of them will do particularly well in this period and some will do less well, shall we say. And I think that's been your experience, certainly in the first quarter. How do you actually manage this with the prices bouncing around like that? Because in theory, I imagine there are opportunities to buy things that they might want to buy that will occur. But at the same time, you've got to cope with the downdraft in some of your other holdings. So how does it actually work in practice? How much turnover falls out of all this kind of market behavior?
So it's interesting. We've got 11 stock pickers in the portfolio, and they all address things slightly differently. So the majority of them are very long-term stock pickers. They tend to have pretty low turnover, maybe 20, 30% per annum type turnover. And so a lot of what we're doing with those managers is really challenging them on the stocks they own. Are these companies going to be ones that can withstand this kind of volatility? They'd known in advance that there was a danger of tariffs coming in that was quite clear to everyone. Had they put in place a portfolio that they felt was robust? Not quite, but almost, regardless of the regime that's in place. And so a lot of them, it's really challenging them on whether anything has changed in the thesis on the companies they own. There's clearly going to be short-term, medium-term volatility in those companies, but are they ones that have got pricing power, can withstand some of these things in asset-like businesses, looking at the nature of the supply chain and really understanding whether they are flexible companies that can withstand what's going on. And then at the other end, you've got one or two managers that do change the portfolio around a bit more and really will try and think about what the momentum is in the market, which are the areas that the market is focusing on. They will tweak the portfolio as such. And so the likes of GQG in particular, Rajiv Jain, he will move the portfolio around quite a lot. And we've seen quite a bit of change in his portfolio, for example, through the back end of the first quarter and into April and May. His portfolio has changed quite dramatically. You've got a Jennison, who are a growth manager. They will remain very much a growth manager throughout, but where they're finding opportunities will change quite a bit over time. They tend to focus not just on the growth prospects of companies, but whether there's positive inflection in those growth opportunities of the various companies. And so they will change the portfolio a bit more than some of the others, where a number of the other managers in place haven't really made much change to their portfolios at all. They've bought on price weakness in some of the stocks that got hit post-Liberation Day where they felt that that was unjustified, and they might have trimmed or sold the odd portfolio position, but they haven't made dramatic changes to the portfolio. And interestingly, year to date, we haven't actually changed that much in the weightings of the managers either. We feel as though the portfolio is pretty well positioned, and the changes to the structure of the portfolio have mainly been driven by the changes in particular in GQG's portfolio, but also a little bit in the Jennison portfolio as well, as I said.
So if we sort of paraphrase Warren Buffett, price is what you pay and value is what you get. Is it the case that over the course of the last 5 months, you would say that what was originally seen as a potentially, I have to say, disastrous tariff policy has actually kind of ameliorated now? Do you get that feedback in terms of the fact that if they've come out of this with a similar sort of portfolios that they had in many cases before, haven't changed very much, can we deduce or infer that the tariff threat, if you like, has been overstated?
Well, actually, I wouldn't necessarily go that far. I mean, I think it's quite interesting that markets are slightly above where they were before Liberation Day, which is an interesting situation to be in, given that although there's been a rowback on a number of them, we still are sitting with higher tariffs than we had prior to that day. So, though we would look at it and say there are still some concerns there, it's very early to call what's going to happen here. The immediate impact has been small. Lots of companies have had inventories built up in the various countries, and so it hasn't really hit any of the companies yet. Still to be determined how that's going to play out, and the real world impact of all of these tariffs. And indeed, if there's going to be a rowback or deals signed that are different to the expectations. So I wouldn't go as far as that, Jonathan. I mean, I think the real left tail outcomes have maybe been reduced a little bit from some of the fears in the first few days post announcement, certainly with the talk of a China trade deal, but certainly wouldn't be sitting here saying there's been no impact. The point I'm making is that for a number of our managers, they had been anticipating that some of this sort of thing could happen, and that was in the portfolio that they'd constructed. And so there's still some concern on that, and they have made minor tweaks to their portfolios. But if we take GQG, for example, in our portfolio, they've actually moved the portfolio to be a lot more defensive over the first quarter. They sold pretty much all of their Magnificent Seven exposure. They've sold a lot of their technology exposure, and the beta in their portfolio has reduced quite dramatically. They've been buying much more stable companies, lower growth type environment. They have gone more value in their portfolio. And so overall, our portfolio has shifted a little bit on the basis of that. I mean, clearly GQG make up about 12% of the portfolio in their global portfolio, which is the one that I'm really referring to. So that has an impact overall, and Jennison as well have reduced some of their exposure to the Magnificent Seven stocks and some of the big growth large cap tech firms that have done very, very well in recent years. So there has been a bit of a tweak, but my point was more that a number of the stock pickers that we'd had in the portfolio hadn't had to make too much change because they had been anticipating some impact of tariffs and the like in advance.
So at your recent AGM, you made the point that your performance has been strong over 3 years, both in absolute and relative terms. But in the more recent few months, in the first quarter, certainly, you lagged by 1 or 2%, I think, where you were. And of course, in the background, we've still got this problem of a very concentrated market, with the US still being dominant. And as you say, big tech still being very dominant within that and bouncing back quite strongly. So that is a challenge for anyone who's doing active management like you are. So how do you see that developing from here? I mean, are you in the camp that's hoping for a reduction in the dominance of big tech in the US indices? I mean, would that be helpful to you given your strategy?
The thing that would be most helpful to us, given our strategy, is that fundamentals come through in the entirety of the market. And so fundamentals start to drive share prices. What we think we've seen in recent years is that a small number of companies have dominated, yes, but there are a huge number of companies that have been delivering well beyond expectations in many cases in earnings growth. And that hasn't yet been reflected in share price performance. And so that's really what we need to see come through to have strong outperformance from here. Now, we'd be confident that that will happen. That has to happen over the very long term. Fundamentals do drive share prices, but that can go for a long period of time. We don't need to see, for example, Magnificent Seven to underperform for us to do well. we are underweight the Magnificent Seven. So in isolation, that would be a positive in relative return terms. But that's not going to be the key driver either way of performance. It's really going to be whether fundamentals come through in share prices. One of the statistics that I alluded to at the AGM was that if you take the last 50 individual calendar years, there have only been 3 of those 50 calendar years where less than 30% of the stocks in the S&P 500 have outperformed. In fact, in those 3 years, it's been close to 25% of stocks have outperformed. And 2 of those 3 years were 2024 and 2023. So it's been a quite extraordinary period, an incredibly hard period for active managers to outperform when very few companies are doing that. Now, that's another way of saying that there's been dominance of a small number of companies, but this really highlights quite how extreme that has been. And certainly, if you look at the last sort of time you had that sort of environment happening, there were 2 years where you had about 30% of stocks outperforming back in 1998, 1999. You then had about a decade thereafter of active managers significantly outperforming passive. That then switched back to nearly a decade of the other way around until recent times. So I would be sitting here saying that now would be an interesting time for someone to be thinking a switch from active to passive made sense after a period of passive being the most attractive area for quite a long time. We've seen these cycles in the past, and you've had that most extreme period where active management's had a tough time in the last 2 years. So we sit here pretty positive about the outlook for both active management and, in particular, long-term stock pickers that think about true valuation based on fundamentals of companies with a sort of 3-5 year time horizon. And that's what we've got in the portfolio. So we track how our portfolio, both at an individual manager level and at the total portfolio, has been performing in fundamental terms and breaking down that return that it's achieved from, has it been calling the fundamentals of the businesses correctly? And then separately, has that been reflected in the price earnings multiple of those companies that the market has been putting on those? And certainly over pretty much any of the periods you want to look at, our portfolio has significantly outperformed the index in fundamental terms, but just not necessarily in share price terms, because the price multiple expansion has been focused on a small part of the market. And so we see any kind of stop of that, let alone reversal of that, then that would be a good period for our portfolio.
Do you have, given your experience in the market, an idea why this should be the case? In other words, why have we seen these 2 years of very strong dominance by a very few number of stocks? Obviously, 98, 99, there was the internet bubble, of course, the technology story. Now that we had another technology story, is that it? Or is there something else going on here that we might be looking at to explain why we had these sudden periods of exceptionally narrow performance?
Yeah, so there's definitely been that technology story, and in particular, the AI story has really driven stocks for the last few years. And so that's definitely part of it. Another part of it is this tends to happen a bit more where you get big macro events. And so if you get big macro events, the market focuses on short term, what does that mean for a bunch of stocks and themes in portfolios rather than individual bottom up analyses. And if you look at the last decade, we've really had some quite extreme macro events. We've had COVID, we've had some wars, we've got the Trump policies around tariffs. These are quite significant macro events that you perhaps haven't seen as often in some previous periods. You always get them in the past, but you wouldn't necessarily get so many in such a short space of time. And then you've also, in reality, had a rise of retail investors, particularly in the US, and a number of those running some options and levered strategies on some popular stocks and well-known stocks. And so you take a lot of that with the rise of passive, all of that together, I think has been culminating in what's actually happened in the markets. Now, our view is we don't have a thought on when that's going to suddenly change in markets or what the catalyst is. It's actually quite difficult to know that in advance, but we sit there comforted by the fact that in the long term, we're confident that the fundamentals of the businesses are going to come through. And let's put this in perspective. Ultimately, the trust's objective is to be a core investment that delivers a real return through a combination of capital growth and a rising dividend. And it has achieved very strong absolute returns. Most equity funds have. I mean, in the period we've been running it, it's been producing sort of 9% per annum total returns, real returns in excess of 5% per annum. So shareholders have been getting very good outcomes. It's just you could have got an even better outcome, or roughly the same outcome over the full 8 years if you'd have invested in a passive trust. We think that will not be the case over the long term, and certainly over the next 3-5 years from here. But we don't have a view on what it means for 2025 specifically.
Sure, take that. Okay, well, you say that AI is a big story. It is a huge story, obviously, and potentially you got some very significant outcomes, but we don't know for sure yet exactly what they'll be and who the winners will be. How do you find that being reflected in the portfolio that your stock pickers are putting together? How would you describe their approach and their thinking about AI as an investment theme?
So quite a mix across the stock pickers. The growth managers generally tend to be more reflective of some of those things in terms of the more pure plays on AI and the like. But I think if you were to talk to any of the stock pickers, they're all thinking about the impacts AI are going to have on the wider economy at large, how each company's going to have to adapt and allow for AI progression in what they're doing. So that, this isn't just a story in the technology space. But what tends to happen in these themes is that in the early days, that tends to all be about the infrastructure and the hyperscalers and the like that deliver on that. And then it moves to, well, who are going to be the real winners from that in terms of the apps that are developed on the back of it. And so that's the time scale and the life cycle that you see in this space. And so a lot of the growth managers have been evolving the kind of winners that they expect to see through this time. Also, I listened to your podcast with Ben Rogoff, and you talked about this in some detail on AI in that particular podcast, and how DeepSeek had a big influence on the market. Everyone thinking about what this means for technology going forward, the spend on semiconductors and the like. And just this idea of how quickly AI is moving on and being able to move to sort of 5-10 times quicker each year was some of the talk there. How much of it's going to be built in, will it continue with the US exceptional, and will the US continue to be the winner in the AI revolution, or are China moving further and further forward in this? And a lot of that depends on which stage of the life cycle you are. So quite a few of our managers have been evolving what they're doing. As I said, GQG have completely come out of all of this, feeling as though some of the valuations have gone a bit too far in recent times, but they will change their portfolio as and when valuations change on that. Jennison similarly have been feeling that some of the big winners of the last few years have now got that reflected in prices, and it's going to be a new set of technology winners that will do that from here. And so have been involving their portfolio a little bit. They actually have got some exposure to some Chinese companies around this area as well. So quite a mix in the portfolio. And certainly when we're talking to each of the stock pickers about the companies they've got, regardless of what sector they're in, we're talking to them about what AI means for the companies that they've got, both in terms of what they're doing internally, but also what their competitive threats are and how that's changing.
I was looking briefly at your top 10 holdings, and well, it's interesting. I think I'd be interested to know how this has sort of changed and to what extent. I mean, you've still got Microsoft and Amazon at the top, and then you've got Meta as well, but you don't have Alphabet in the top 10, for example. So your guys are making some choices in that kind of arms race going on there, but Alphabet obviously for slightly different reasons, and similarly Apple. I don't see Apple in the top 10 either. So you are taking some quite big relative positions, are you there?
That's right. So we have at times, but generally we've had zero in Apple in the entire 8 years. So as I say, there's been one manager that's occasionally held a small amount in Apple, but that's been our biggest relative position pretty much throughout the 8 years. And that's obviously been painful in relative terms. So that's a stock that has been significantly underweight. Tesla is something we haven't owned in the portfolio. So again, that's been a big underweight position. Alphabet, we've been significantly overweight for quite some time, and then more recently underweight. So there's been some trims on the Alphabet position. We've still got a holding in Alphabet, but relative to its index weighting, we're slightly underweight. Nvidia, we were overweight for quite some time, and then went underweight in the first quarter of 2024. And so that was painful through the last 9 months of 2024. Obviously was more positive in the first quarter of 2025. But yeah, we remain underweight, in particular Apple, Tesla and Nvidia, a little bit in Alphabet, more neutral to slightly overweight in Amazon, Microsoft and Meta.
You are listening to our Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. If I looked at the portfolio, say, now against a year ago, what would be the most significant moves that you've made in that time? I mean, you talked about you haven't done much so far this year in net, but over, say, the last year, can you give us some flavour on that?
Yeah, so there's probably two ways for me to take that. One is the changes we've made to the manager lineup in terms of who the stock pickers are. And so about a year ago from now, it was maybe 13, 14 months ago, Ben Whitmore from Jupiter came out of the portfolio. He announced that he was leaving Jupiter in the summer. We took the opportunity to replace Ben with one of our preferred managers that had a similar kind of deep value style. And so Arga came into the portfolio about that time of the year. Then in October, when we had the Witan combination, we were making a number of changes to the portfolio naturally as those new assets were coming in. We employed a transition manager to help us with that, to keep those costs down, which was very successful. And as part of that, we brought in a new manager, which was Jennison Associates. So Jennison are a manager that we've liked for many years. We actually use them in a number of our other portfolios and have done for a number of years. But they weren't in the Alliance Trust portfolio as was. They were in the Witan portfolio. We took the opportunity to bring them into the new combined Alliance Witan portfolio. This is a manager that, yes, we liked, but also they were slightly different to our other growth managers that we had in the portfolio. And we were able to bring them in at almost no cost because we could do some in-specie stock transfer from the Witan assets into the combined Alliance Witan portfolio. So that was one thing we did. It was just an addition of a manager. But the other thing we did at the same time, because it was a good time to be able to do it and keep the costs down, was a business as usual manager change where we replaced Black Creek with EdgePoint. So Black Creek's a manager that had been in the portfolio since we took it over in 1st of April 2017. And we continue to like Black Creek. We think Bill Canco, the lead portfolio manager, is a good portfolio manager, still like him. But we took the opportunity to bring in EdgePoint, who's another manager that's relatively similar in terms of the way it thinks about the world and is in a slightly different stage of its life cycle. And so Bill is closer to retirement than the managers in the EdgePoint portfolio. The number 3 on the team at Black Creek had left, unfortunately, due to ill health. And so we took the opportunity to bring in who we think's a great manager in EdgePoint into the portfolio at that time. So you've had 3 new managers over that sort of 14-month period coming into the portfolio, with 2 coming out. That naturally has made a few changes to the portfolio. But then, as I said, probably the biggest change to the portfolio has been in the most recent period where GQG have really swung the portfolio around. And so the portfolio looks a little bit more defensive today than it did, well, even 4 or 5 months ago, but certainly relative to 12 months ago.
Now, one of the things, of course, is that I think certainly for private investors, They probably haven't heard of hardly any of the firms that you employ. That's the whole point, really, because you're employing sort of specialist fund managers who you can't access directly as a private investor. That's the whole point. But tell me, out of interest, how many UK fund managers do you now have in your roster? Because if you've got rid of Ben Whitmore, might you look at him again now he's started his own firm? But I'm interested in what your UK representation is here.
So first thing to just say is, in terms of the portfolio manager, we've never had anyone that just invests in UK equities. So Ben was running a global portfolio for us. In terms of who's based in the UK, then we've got Metropolis and we have Veritas, who are both based in the UK. But the other managers are based elsewhere in the world, be it Japan or the US or Canada as examples. But yeah, two UK-based managers that are in the portfolio as of today.
Right, so you don't have any kind of British bias in your approach. I wouldn't expect you to say you had, by the way, but I'm just interested in that. It never occurred to me before to ask that question.
No, well, as you say, one of the things we're trying to do here is bring access to managers that you wouldn't otherwise easily be able to get access to in UK retail space, and who we think are the world's best stock pickers. And the UK is a significant asset management industry, but it's not the only one in the world. And so we want to make sure that we're bringing who we think are the world's best stock pickers to UK retail for something that you couldn't do yourself.
So, two other questions I need to ask you about, and it's always worth asking this at this point, given your share register. Tell us what you've been doing with your gearing. I think you've reduced that slightly, but you still have some gearing in place, do you? And is that going to be effectively the norm as far as you're concerned?
The board ultimately set the gearing policy, and the policy has been, ever since we've managed it, that we expect the strategic average gross gearing to be about 10%. So about 10% of the trust in borrowings. Now, we can then move to be higher than that or lower than that. Now, we would tend to be in a fairly small range around that in gross gearing terms. We tend to be in the 12.5 down to 7.5% range. We can go outside of those. If we were particularly positive about equities or particularly negative about equities, we can go to the board and ask if it's okay to go outside of those ranges. And ultimately, then it's a board decision. But most of the time, we will use our discretion to be in the 12.5 to 7.5% range. We don't want to dominate our relative returns based on us taking a view on the binary decision of whether equities are going to outperform cash or not over the course of the next 3, 6, 12 months. That's not either our biggest skill set or what we think investors are buying in this trust. So, as I say, we've generally been that 7.5 to 12.5. In recent times, it's been at the lower end of that range, more like 8 or so percent. When markets fell, that moved up to more like 9% or so. Clearly, as markets go up, we just follow a typical rebalancing idea that if markets have performed particularly strongly, we tend to be at the lower end of the range. If markets have performed particularly poorly, we would increase the gearing on the portfolio, given that you're likely buying at more attractive prices, and we take that long-term view. As it stands today, we're at about 9% gross gearing, just a little bit below, more like 5% net gearing, 5.5% net gearing in the portfolio as it stands today.
Right. And the other things, obviously, that are concerned to trust investors are always the dividend and the discount. I think on the discount, first of all, obviously, there was an opportunity. You moved out, I think, very, very briefly to around 10%, but you're back in the normal range, which is around 3 to 5%, something like that. Would that be fair?
Yeah, that's fair. So our discount's actually been incredibly stable. It's pretty much been in that 4 to 6% range over the entire 8 years that we've been managing. As you say, there are days where it might flip up for a few days, but ours has been incredibly stable, much more stable than that of the sector average. We've got a lower discount today than the sector average, which is getting up at the sort of 8, 9%, and ours is at the 4 or 5% discount. The board have been consistent in saying that they will manage that discount appropriately and look to keep it stable. They will use buybacks when appropriate. We've been in a situation where we haven't had to do huge amounts of buybacks. That's picked up a little bit, but I think in 2024, 1.2% of the trust was bought back. It was about 2% in 2023. We've had much lower buybacks than the sector at large and had a lower discount. I think that is an advantage of A, people buying into the philosophy and approach, but B, it is one of the advantages of being a large trust that can be owned by the larger investors as well as the smaller investors, and it looks attractive to multiple types of client, be that institutional, be that retail. So I think that is one of the advantages that was alluded to with the combination with Witan as well.
And what can you say about the outlook for dividends? Obviously, again, that's a board matter, but the dividend has been increased again, quite notably, I think. So how would you see the outlook for dividends from here? Obviously, you're not a great yield stock, but you do pay a dividend. What's the outlook for that?
Well, the board have been quite clear that they will not be moving away from their progressive dividend policy. So you can expect to see increasing dividends. It's been 58 consecutive years of dividend increases. Of the AIC Global Dividend Heroes, it's had the highest dividend growth over 5 years of any of them. And as you say, the most recent dividend announcement is an increase. It's got huge reserves in the portfolio, 3 billion plus in reserves. And so it can continue that progressive dividend policy for a long time. As you say, we don't manage the portfolio on a yield basis. We don't give restrictions to the managers and what they need to do. There will be times where higher yielding stocks are more attractive from a total return perspective, and we will have a higher yield on the portfolio than that's being paid out in the dividend on the trust. And there will be periods where it's the other way around. That's the big advantage of an investment trust structure, but certainly no issues with the board continuing the progressive dividend policy.
So as I mentioned earlier, you completed the merger with Witan back in October last year. So you've had about 8 months of experience. What has been the impact of that? How has your share register changed? How stable has it been? And what have been the benefits of having that merger in place?
Yeah, I mean, in terms of the shareholder register, there was actually quite a lot of overlap in shareholder register between Witan and Alliance Trust. Both had a pretty large retail presence rather than just having the large wealth managers as investors and the like. Both have been spread out. There were some investors in common across the two, and we spent a fair bit of time with all of those going into the combination. But we've actually had some new ones joining. I mean, ultimately, the move into the FTSE 100, which happened in the first rebalance of FTSE after the combination, so that was in December, that's led to a number of new shareholders that neither of the trusts had in place at the time. But on the whole, we've had a very stable share register. In terms of the second part of your question around what the advantages are of this, well, we think that FTSE 100 inclusion was an advantage that just helps the liquidity on the trust. It means there are some other investors who would otherwise be nervous about investing in a smaller investment trust that hasn't got the liquidity they require. If they're larger investors, that makes it more attractive from that perspective. The other advantage is just you get a lot more profile in the industry, which again helps to get the story out there, which ultimately long term helps on the movement of the discount to come in, having to do less buybacks, all of those advantages. You have clearly the advantage of a larger trust means that the OCR falls. We have a sliding fee scale on the management fees. And so that has been the case. And you can invest more in dollar terms or sterling terms for no change in the percentage of the trust terms on marketing and getting the message out there again, which helps on that discount piece. So lots of reasons that we think advantageous. We do think, there will continue to be consolidation in the investment trust sector, and being one of the larger ones, one of the consolidators rather than consolidatees, we think is beneficial for shareholders ultimately.
Right. That was going to be the last question in a way. Do you see more scope for Alliance to be a consolidator looking across the sector at the moment? And is that one of your strategic objectives?
Yeah, I mean, ultimately, that's a board decision. But the simple answer is yes, the board will continue to look at opportunities to do things that are in the long term interests of shareholders. And all of the things that we talked about as advantageous for the Witan combination could be advantageous in other examples as well. Now, that's not to say that the primary goal of the trust is to go out and acquire more investment trusts. The primary goal is to produce good returns. And that's what we spend the vast majority of our time doing every day, is thinking about, is this portfolio best set up for future performance from here? That will continue to be far and away more important than anything else. But if there are opportunities to do things that continue to get the OCR down, that continue to allow us to invest more in getting the story out there and getting more direct retail investors as shareholders, then I'm sure the board will be looking at those opportunities through time.
And just on that, the point you mentioned about the retail shareholders, obviously that's a significant feature of your share register. There's been quite a lot of debate about how and to what extent investment trusts can communicate more effectively with their retail base. That was highlighted by the Saba saga, I think. In your case, how do you see that? Obviously, Alliance used to have its own direct contact with its shareholders. In terms of the amount of effort you're putting into publicizing, marketing, and so on, has that significantly changed in terms of priorities?
In terms of our priorities, they haven't changed overall, but some of you will have noticed that we've been doing a fair bit of advertising in recent times on television, radio, in the usual magazines and the like. We continue to do that. One of the advantages of being a larger trust is that you are able to spend enough to do those things and it have a very small impact on the returns of the portfolio from a cost perspective. And so that has been increased in recent times. We've done a lot of analysis of our shareholder base in recent times, understanding who those shareholders are, the kind of things that are most interesting to them, and trying to get access to people across the age spectrum. And so that's been a lot of the work that's been done on all of that. But as you noted, we're actually relatively unusual for some of the trusts in that we've always had a pretty significant retail base in the trust. And so whilst the number of others are doing a lot to try and get to that stage, we're fortunate enough to be at that stage today. And we need to always be on the lookout to be increasing the interest from retail investors, but we're starting from a good space.
Did you notice any significant change in the turnout for your AGM or the voting on your AGM? Obviously, there was a lot of noise around the fact that those who were the targets of Saba managed to get an improved turnout at their meetings. But was it business as normal with you? I imagine it probably was, wasn't it?
Yeah, business as normal. It was pretty similar numbers. Certainly in person, it was similar numbers this year to previous 2 or 3 years. That didn't change much. We maybe had a few more online this time than before, but that's more because we've been making it more easily accessible via virtual means than was the case a few years ago. But no major change in number of attendees.
So that brings us to the end, I think, of our conversation. Thank you very much, Craig, for that. As I say, been a very tricky, volatile period, but I'm sure that your stock pickers will continue to do their best to bring the bacon home for their shareholders. So thank you very much. And we look forward to catching up again perhaps later in the year and seeing, well, for example, whether there's been any move away from the US towards other parts of the world. That's an interesting theme. We've heard a lot about that. You won't be in the vanguard of that, presumably, because the markets will take you where they want to go on that one. Would that be a fair point?
Yeah, as I said before, we try and make stock picking drive everything. So we won't typically run big country sector positions relative to the benchmark. And obviously, the benchmark has got a large proportion in the US. All that said, we are underweight the US. And a decent amount of that is the Magnificent Seven underweight. So, if you take the Magnificent Seven out of it, we're probably pretty similar to the weighting in US equities. But because we're about 7 or 8% underweight the Magnificent Seven, we're close to that in terms of underweight the US.
So that was Craig Baker, the lead portfolio manager of Alliance Witan, the global investment trust that did its big merger back in October last year.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.